In today's world, investors are increasingly looking beyond just profits. ESG investing, short for environmental, social, and governance, is all about putting your money into companies that prioritize sustainability, social responsibility, and strong corporate ethics. But the big question remains, can you really make money while doing good? In this quick dive, we'll explore what ESG investing is, how it works, and whether it's possible to align your financial goals with your values. Let's get into it. Today we will talk about what is ESG investing? Can you make money and do good? So before we start, make sure to hit the like button and subscribe to my channel. 1. Understanding ESG investing, the basics. ESG investing stands for environmental, social, and governance investing, a strategy that evaluates companies based on how well they perform across these three key criteria. Unlike traditional investing, which primarily focuses on financial returns, ESG investing integrates ethical, social, and environmental factors into the decision-making process. Environmental criteria examine a company's impact on the planet, such as carbon emissions, resource usage, and waste management. Social criteria focus on relationships with employees, suppliers, customers, and communities, covering issues like labor practices, diversity, and human rights. Governance criteria involve the company's leadership, executive pay, audits, internal controls, and shareholder rights. Essentially, ESG investing seeks to invest in companies that are not only financially sound, but also responsible corporate citizens aiming for long-term sustainable growth rather than short-term profit. 2. The rise and growth of ESG investing. ESG investing has evolved rapidly over the last 2 decades. What began as a niche market driven by ethical investors and activists has grown into a mainstream investment approach embraced by large institutional investors, asset managers, and retail investors alike. Global awareness of climate change, social justice movements, and corporate scandals have fueled interest in ESG principles. Regulatory bodies worldwide are also encouraging transparency and sustainability reporting. According to data from Morningstar, ESG fund assets have grown exponentially, crossing trillions of dollars globally. This growth signals a shift in how investors perceive risk and opportunity, recognizing that companies with strong ESG practices may be better positioned to navigate environmental challenges, regulatory pressures, and shifting consumer expectations. 3. How ESG investing works, strategies, and tools. ESG investing can take several forms. The simplest is negative screening, where investors exclude companies or sectors that do not meet certain ethical standards, such as fossil fuels, tobacco, or weapons manufacturers. Another approach is positive screening, selecting companies with exemplary ESG practices. More sophisticated strategies involve ESG integration, where financial analysis incorporates ESG metrics alongside traditional financial indicators. Impact investing, a subset of ESG, actively seeks investments that generate measurable social or environmental benefits in addition to financial returns. Investors often rely on ESG ratings and scores provided by specialized agencies like MSCI, Sustainalytics, or Bloomberg to assess company performance, although these ratings can vary widely due to differing methodologies. Despite these challenges, ESG tools help investors identify companies aligned with their values and risk appetite. 4. Can you really make money with ESG investing? A common question around ESG investing is whether it compromises financial returns. The myth that doing good means earning less is increasingly debunked. Numerous studies suggest that companies with strong ESG performance often deliver competitive or even superior financial results. This is because sustainable companies tend to manage risks better, avoid costly controversies, and capitalize on emerging market trends, such as clean energy and ethical supply chains. For example, MSCI research found that portfolios with high ESG ratings often showed lower volatility and better risk-adjusted returns over the long term. However, like any investment strategy, ESG investing is not a guaranteed path to profits. Performance depends on market conditions, selection criteria, and the investor's time horizon. Still, many investors find that aligning their portfolios with ESG values does not mean sacrificing growth. 5. The social impact. Doing good beyond dollars. ESG investing is about more than just returns. It's about contributing to positive change. By allocating capital to companies that prioritize environmental stewardship, social justice, and ethical governance, investors can influence corporate behavior and help address global challenges like climate change, inequality, and human rights abuses. For example, supporting renewable energy firms can reduce carbon footprints, while investing in companies with strong labor practices helps promote fair wages and safe working conditions. Furthermore, ESG investing encourages corporate transparency and accountability, pushing companies to improve their policies and reporting standards. For socially conscious investors, this dual goal of earning returns and making a meaningful impact creates a sense of purpose and engagement that goes beyond traditional financial metrics. 6. Challenges and criticisms of ESG investing. Despite its growing popularity, ESG investing faces notable challenges and criticisms. One major issue is the lack of standardized metrics and inconsistent ESG ratings, which can confuse investors and lead to greenwashing, where companies exaggerate or misrepresent their sustainability efforts. Additionally, the subjective nature of social and governance criteria means that investors may have differing opinions on what qualifies as ethical or responsible. Critics also argue that some ESG funds may prioritize marketing over genuine impact or rely heavily on exclusionary tactics rather than proactive engagement. Moreover, the complexity of integrating ESG factors into financial analysis requires expertise and data that may not always be reliable or comprehensive. These challenges highlight the need for improved regulation, transparency, and investor education to ensure ESG investing fulfills its promise. 7. Practical tips for investors interested in ESG. For individuals interested in ESG investing, the first step is to define your personal values and financial goals. Decide which ESG issues matter most to you, whether it's climate change, social equity, or corporate governance, and research funds or companies aligned with those priorities. Use ESG ratings and third-party research to assess potential investments, but also dig deeper into company reports and news. Diversification remains key. Avoid concentrating solely in one sector or theme. Consider speaking with a financial advisor knowledgeable about ESG to tailor a strategy that fits your risk tolerance and time horizon. Finally, be patient. ESG investing is a long-term commitment that aims to foster sustainable growth and impact over time, rather than chasing quick returns. 8. The future of ESG investing. Trends to watch. Looking ahead, ESG investing is poised to become even more influential in global capital markets. Regulatory frameworks like the EU's Sustainable Finance Disclosure Regulation, SFDR, and the U.S. Securities and Exchange Commission's increasing focus on ESG disclosures will drive greater transparency and standardization. Advances in data analytics and artificial intelligence will improve the quality and consistency of ESG metrics. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.